All right, so I always stress how important it is to do your homework and research on the stocks that you're buying before you buy them. And there's the two types that you should be doing. It's the technical research and then the fundamental research. Now, the fundamental research has to deal with basically the financial statements or like the ratios of how a company is doing. So you'll be looking at like price to earnings, EPS, price to book, cash flows, and basically this tells you how the company was doing in the past and what it expects to do in the future. So there's two types of fundamental analysis. You got quantitative and qualitative. Qualitative, you can't quantify these numbers in the category basically. Like it's basically categories like management or like the technology that this company has is disrupting its industry. So like Tesla basically, like the type of batteries they have and their management with Elon Musk. Like these aren't a number, but you know it has an influence on the company. Now the other quantitative, it can be quantified. Like and these are like the assets, liabilities, ratios, looking at earnings, balance sheets, and all of that. So fundamental analysis. There's the messiah to investing. He loved this shit. He said the best way to invest was basically just go into a room and just think. Don't have anyone else chirping in your ear about it. You just read the newspaper, see how these companies are doing, use your common sense on these that you know about these competitors, and basically that's all you need to know with investing. Don't need any superpowers, anyone can do. So there's two types of fundamental analysis. You got the quantitative and qualitative. Quantitative are numbers that you can see, like the assets, liabilities, ratios like PE, PS, price to cash flow, price to book, and all the other financial statements too. Then you got qualitative, and those are basically the stuff that aren't numbers that take into consideration of how a company is going to be doing, and that's like the management or the technology disruptions that this company has. Like I said, a huge example would be Tesla, like how it has great technology that not its competitors don't have, and its management is on a different type of level. So a nice way to look at these companies and understand how they're doing with the non-numbers aspect of fundamental analysis is doing a SWOT analysis. And that's looking at the strength, weaknesses, opportunities, and threats of this, what's it called, the company you're looking at. And you obviously want the strengths and the opportunities to outweigh the weaknesses and the threats. So, like, for example, how, like, all these companies really have, Etsy is questionable, a really good market cap, and they can use that to their strengths. And most of them, except for Alibaba, has the government actually, it helps them. They are in a capitalistic economy, which helps their company. But Alibaba is in a communist economy, which is just eating away at the end. They jealous as shit of how good their company's done. But then threats, competitors is often like a threat to a lot of companies. For example, Facebook with like its earnings just getting destroyed recently because of its competitors like TikTok taking all of their subscriptions. So this is just the most basic and easiest way to like examine a company and how it's going to do. After that, you got the numbers that you gotta look at, like these ratios. So like these are the most common really, and these are the numbers that you want them to hit. Like you want P to be under 15. You want what's it called? Price to book to be under 3. You want beta to be under 1. So basically these stocks are, if having these numbers, are going to be a low volatile company that is gonna, it's not risky. So the risk reward, remember, is always a fact. And if it's low risk, it's gonna be not low reward, but hey, you're getting what you pay for, and you'll be able to sleep at night a lot easier. This little graph just depicts like the average number the S&P would have for its EPS and its PE. And this is a good way to depict like what what level that PE or EPS should be, but also you want to look at the average of their industry. You want to look at their competitors, and you want the company you're buying to have better numbers than these competitors. And these are the numbers basically. I don't know what more to say. They right there. You want the definition of these terms? You join my Instagram page or my Discord, and all the definition is there for you. All right, so we got more numbers. There's a lot of numbers you can look at with this shit. And so, like, basically, you want the target price to be above, obviously. You want high volume. You want, what's it called? Analysis to be saying, yeah, this is a company I would buy. And basically, you never want to buy something overbought. You want earnings to constantly get better. You want sales to constantly get better. You want the higher market cap because that's just, what's it called? It's an advantage to a company. You want a company with a little bit of money or a lot of money. Hey, if you want a company with a little bit of money, you know the risk is going to be more, so the reward is going to be more, but it's a different strategy that you're going for. Now, over to the left, these pictures are the picture symbols, of the top 10 market caps of any company in the world. And on the left, on the right over here, it's the top 10 with revenue. Now, as you can see, oh, what the fuck? No, you gonna go back? Don't worry. Now, as you can see, what's it called? You got Apple in both of these lists. Amazon is in both of these lists, and Berkshire Hathaway is in both of these lists. And I am huge supporters for these companies. Also, Walmart. For times like this, you want companies like that. Now, also, you want to look at the long-term run of these companies. So basically, you pull up a chart like 5 year, because you don't want just like a hit and miss, like this company just did good 1 year, now I'm going to invest in it. No, you want a company that does consistently good. Now, there's different types of stocks, and they should have different returns, basically. So the first one, BHP, that's a little dividend stock, and you see it's only a 75% return. That's something you would see with a dividend stock. Like it goes up and down, it usually stays at the same level since it's over here just handing out its money. Now Shopify over here, as you can see, that's up close to 2,000%. It was up over 3,000%. And that's typical for like a growth company, really, because it'll go up a lot, but then it's going to come back down, as you can see over there. Got cut in half basically. Apple too, it's not more consistent. You see, it's up over 400% past 5 years. It's more than a dividend. It's less than the growth. It gives out dividends even, and it doesn't drop a lot. Like one thing you want to look at in these charts too long term is how does it like handle these recessions? How does it handle getting hit by COVID? How did it handle the housing bubble 2008? How did it handle the dot-com bubble? And that's another thing too. You want these companies to go back all this way too, and it's just less risky. They've been through some shits and they know how to deal with it really, and not just know how to. They have the means and the money to deal with situations like this. So that's all you need to know really about fundamental analysis.